Joining us now is Storch Advisors CEO Gerald Storch. So we're looking ahead to retail sales and retail earnings. And broadly, Jerry, the story has been the consumer's in good shape. Got a lot of stimulus, had pent-up savings, lots of pent-up demand. Are you seeing signs that things are changing?
The consumer has held on better maybe than they should have, but sales have been declining. If you look at a year-over-year basis, since last July, it's been kind of a straight line down in terms of the peaks that we saw last summer. So it's clear the consumer is very, very, very stressed. Even the great growth that we've seen in dining out and travel is beginning to fray at the edges. So I'd be very cautious going into these earnings as you look at tomorrow, and not all boats are going to rise.
Oh, so you're more cautious than everybody else, because everyone else thinks like the jobs market is humming, unemployment rate is near record lows, so consumers should be in pretty decent shape.
Well, they're still spending somewhat, but it's not the levels they've been at for several years. It's almost like they spend forward and are now starting to run out of gas here. And, I'm a big believer in the value players like Walmart, very strong positioning, great strength in groceries, which is still where it's at, groceries and essentials. TJX, another great value player. But I wouldn't be so positive when it comes to Target or Foot Locker, for example, or even Home Depot. Target has been struggling for quite some time. It's a great brand. Leadership is very well considered there. But the bottom line is that their bottom line is strange. And they said their operating margins might get back to historical levels in as much as 3 years. That's a long way out. And meanwhile, I did a store check yesterday at Target. There were off-brand items in the aisles. The out of stocks were pretty high, even in essential categories. There was a sort of a visual mishmash where they have so many brand shops in there, it almost doesn't look like Target anymore. And so it feels like they're trying too hard instead of just focusing on executing.
Right. So are you seeing big swings, Jerry, seasonally in buying patterns for back to school or holiday at this point?
Well, I wouldn't say that. The holiday was weak. I think by all accounts it was weak. There's no doubt last month was weak. So when I really look at it, and again, I take inflation out of it. Sarah mentioned that 7 straight months of negative sales year over year on an inflation-adjusted basis. When you do that, what you see is actually a straight line pattern since last July. So it doesn't look that way to me. It looks like things are slowing down. We'll have to see what tomorrow's report says. Maybe it'll be a little better. Easter was a little bit more, by the way, in April this year than it was last year, a little later in April. So that helps. As old retailers, we always look at March and April together. And March was so weak. Maybe April will be a little stronger. But don't be fooled by that. I think overall, the consumer is slowing down. There's no doubt about it. And the value players are going to be the winners in that kind of environment.
I just want to zero in on what you just said about Target, because that's a company you have history with. And it sounds like you're raising more than just macro concerns here, some execution concerns, which is something that the market really, they consider Brian Cornell and Target a good operator, just some issues when it comes to inventories because they were caught off guard by the decline in discretionary spending. So can you just dig a little deeper and tell us what you're worried about there?
Well, the team has done very well under Brian's leadership. But if you go back a year ago, we were surprised by both Target and Walmart and the results that they posted from the holiday season and into the first quarter. They were grossly over inventory, as you know, and their margin deteriorated. People put them in the same bucket. But when you looked at the actual results, Target's were far worse than Walmart's. And quarter after quarter, Walmart has gotten their ship back afloat. And they're doing very well now. And they're sailing off into the future. Meanwhile, Target is still struggling mightily. And when I walk the stores, I know nothing's worse than an old, retailer coming into the store and saying, oh, look, they're doing wrong. We used to do it better, all that kind of thing. But I got to tell you, it didn't even look like Target to me. And I got very, very worried with what I saw, their execution issues against the strategy. Absolutely. And keep in mind, this has been true since both chains began in 1961. This has been true since then. During great times, Target does better. People have a little more money. They spend their way up a little bit. During tougher times, Walmart does better. By any measure, I feel we're in one of those tougher times. We look out to the next year or two, which means it's a Walmart time, not a Target time. So I do think there are issues both strategically, where they do not have the focus on food that Walmart has, and also operationally, where there are still big issues. And just look at the gross margin rate deterioration, look at the inventory situation, the imbalance in the inventory at Target. I think they still have some real issues. And they themselves have come forward and say it may take 3 years to get back to where they used to be. That's a very long time.